Good afternoon, everyone. Welcome to AEM Achieve. This is Mike Coffey with American Equity Mortgage. I hope that everybody can hear me okay. Everybody is in the listen-only mode. We are allowing time for question and answers. You should have a little toolbox on your webinar that has a box in the bottom that you can chat or enter a question. Time permitting, we will get to all questions, or if you have a question during the course of the webinar, please feel free to send it over and we'll see if we can insert it. Welcome to our event, 2015 Regulations, What Realtors Need to Know. We felt that this would be a very appropriate topic based on the regulations that are happening this year. So with that, we'll get to that in just a moment. For those of you that may be new to AEM Achieve, this is an event we put on every month in order to try and come up with different tools, resources, and training from for our real estate professionals. And the intent is to help you grow your business. So we're committed to one goal: get our customers and partners to a better place. Following the webinar, you're going to receive a short survey that will ask for your feedback on the event. We'd really appreciate your feedback, as well as any suggestions you may have for future events. We've got a great schedule for you this year. Following the event, we will also send you a link to this event and all the other AEM Achieve events that we've had. These are always available to anyone for free, so you can access them very easily. So without further ado, I want to go ahead and get on to introducing our guest speaker today. I want to introduce Aaron Davis. Aaron is the CEO of Hillsborough Title and the Florida Agency Network. Aaron began his career with Hillsborough Title back in 1992. In 2008, he took over as CEO and president and owner of Hillsborough Title. He started from a small title shop in Plant City, Florida, and has grown to 27 locations throughout the state of Florida. Now, I will say, although Aaron is in Florida, and I'm actually in Florida as well, what we're going to be speaking about today is federal laws and federal changes, so it applies to all states. So Aaron is going to provide some great information for us. As part of the Florida Agency Network, they are the largest network of independent title agencies. They have a staff of over 200. They have 4 attorneys on staff, and they own their own title plant. They operate around the state in a number of different names, including Trident Title, Paramount Title, and others. So they have a great network. Aaron, welcome to the webinar.
Thanks, Mike. Thanks, Mike, for having me. I appreciate you guys letting me in, and I see there on the screen title expert. I don't know about that too much. I think I've just been in the business so long that I've seen everything go wrong that can possibly happen. So therefore, I'm an expert in the field, I suppose. I suppose so.
Well, Aaron, before we get into the exciting world of compliance, you and I talked earlier about the changes that are going on in the title industry as a whole. And of course, our realtors deal every day with title companies and getting their transactions closed. We've seen some consolidations, and I'm wondering if you'll please share a little bit about what you're seeing in terms of the title environment and how it's going to affect realtors.
Sure. It's been, I tell you, I've been doing this for quite some time, and it's very intriguing to see what's going on. We've never seen a consolidation quite like we are seeing now. Mike had mentioned that we grew from one office in Plant City, Florida. We had one office in 2007. December of last year, we had 8 offices, and today we have 27 offices. So, and this is all from Dodd-Frank. This is all due to what we're talking about here today, Dodd-Frank, CFPB, and the new closing disclosure forms. It's having a very consolidated effect on the industry. The banks and lenders are now responsible for their vendors, which includes title companies and law firms. So it's having a pretty interesting effect.
So are the banks limiting their vendor list? Do you see banks having a different performance with their title companies?
They do. They absolutely do. Our agency, we're one of the largest players in the state of Florida, and so we're in constant contact with all of our lender partners. They're making sure that we have all of our audits, our compliance, our insurances, and in many cases, increased amount of insurance compliance, IT, IT on staff. So it's definitely going through, it's going through those motions now to be ready for what we're going to see in August of this year.
Okay, very good. All right, well, let's go ahead and move into our subject matter for today. The first thing let's do, I guess, let's take a quick poll from our audience. We want to see how many people really know what CFPB stands for. So this is an opportunity for you to be interactive. You can click on your answer on the screen. Tell us what you believe or what you know for the CFPB. What does it mean? Getting some responses. Okay, we're going to wrap it up in just a few more seconds. We've got answers in every category.
Including peanut butter.
Including peanut butter. I guess people like this. Okay, we're going to go ahead and close the poll. I appreciate everybody responding. CFPB actually stands for Consumer Financial Protection Bureau. So, Aaron, why don't you share a little bit about your thoughts on what CFPB is all about?
I will do. And briefly, kind of bringing everyone full speed. CFPB is in fact the Consumer Financial Protection Bureau, and they are the new police. They are in charge of all of the financial markets. They were created under Dodd-Frank to be giving a vast, a huge scale of what they're in charge of. I joke with my realtor partners all the time. I say, you see that little logo in the bottom right-hand corner? If you see that pulling up in front of your office, just take off running, because nothing good is going to come about that. So we'll go ahead and go over to why is the CFPB? The CFPB was created under the Dodd-Frank Act. Dodd-Frank was the Wall Street Reform and Consumer Protection Act passed in 2010, and by definition, the CFPB is an independent agency of the government responsible for consumer protection in the financial sector. The jurisdiction includes banks, credit unions, securities firms, payday lenders, mortgage servicing operations, foreclosure relief services, debt collectors, and other financial companies operating in the U.S. So that is a pretty broad, broad stroke there, and I just liken it to any business dealing with money. These guys are in charge.
Very good. So let's talk a little about RESPA.
Yeah, absolutely. So part of the CFPB and part of Dodd-Frank was they were put in charge of several authorities, one of which being the Department of HUD and RESPA. So they're now in charge of these guys, and so the first thing they did was make sweeping changes to the industry, and they're changing forms and they're changing how closings now occur. So the changes we're going to talk about here today are the TILA-RESPA changes to the Truth in Lending Act and the RESPA Real Estate Settlement Procedures Act. Two things to take away here are this new terminology. We are now going to be referring to what was once the good faith estimate is now the loan estimate, and what once was the HUD statement is now the closing disclosure. So the purpose of these new forms was there was quite a bit of confusion, and especially we have a lot of real estate professionals here on the phone today, and we're accustomed to the old forms. We just got used to them. But if you really think about it from a consumer standpoint, some of them were pretty confusing. So the purpose of these new forms was to better inform the consumer, to get the information out much more timely, and to give a much more effective advanced disclosure well prior to closing. So some of the things that we're going to be seeing here today is some new terminology or new jargon. So so many of us are accustomed to what we were referred to in the past as you see here on the left side of the screen and the right side, old terms and new terms. So number one, lender. The lender is now being referred to as a creditor. The old terminology was borrower, which is now a consumer. Those are I'm not going to focus on those too much, but the next couple of ones are a change in just our vocabulary. So what we used to refer to as the initial truth in lending statement and the good faith estimate are now both combined into one form, which is called the loan estimate. So good faith estimate, GFE, equals loan estimate. The HUD statement and the final truth in lending, so your HUD and your TIL, are now both being replaced with what's now called the closing disclosure. So get used to stumbling over our words. Coming the end of the year, we're going to all be accustomed to calling it the HUD and the TIL. Those are no longer. So it's now closing disclosure. So I'm sure that we'll shorten that down to the CD. The other one too is closing and settlement in general is now being referred to as consummation. I'm not quite sure if that one's going to catch. I can see some of these other ones catching. So, but those are the major changes in the vernacular.
Yeah, I think it will be difficult for people to change their terminology. One question I have for you, Aaron, is are we going to see the verbiage changing on real estate contracts as well? Because obviously, loans and real estate contracts go together. So
I would almost guarantee it, Mike. This change is not just in the forms themselves or just vernacular. It also changes the process a little bit. So this is federal law. So federal overrides state every time. And so you're going to see, more than likely, just after August, September, once we actually see the forms in place and the new procedures, the states are going to have to adjust their sales contracts. The big reason why is because now this form has to be in the borrower's hands 3 days prior to closing. So that contract is going to have to address that 3-day period. So absolutely, I can assure you these terms will show up in your state contracts.
Okay, very good. Thank you for sharing that. So it really behooves realtors as well as lenders to make sure they're familiarizing themselves with this terminology. Good.
Absolutely. So the types of transactions that are affected, and if you just think about it from this standpoint, it's most all of the transactions that we are accustomed to seeing in a traditional sense. Your traditional mortgage and loan products, and your 30-year fixed and variable loan products, and more of your traditional vehicles. What are excluded are on the screen now. Your HELOCs, your home equity line of credits, reverse mortgages, mortgages secured by a mobile home. Or dwellings not attached to land, commercial and business purpose loans, and then creditors that make 5 or less mortgages yearly. So this is having a sweeping effect also on the private money markets and seller-held mortgages as well. But for our purposes here today, we're just focusing on the traditional mortgage product vehicles. So when does this all happen? Well, we've been aware of this now for a couple of years, and it's been a steady build-up to get to August 1st of this year. We've had several pieces of this reform go into place already. Last year, I think it was last January, was the qualified mortgage rule. All of these things have now built up so that the forms go live August 1. So don't expect to see the closing disclosure in place or show up at the closing table on August the 2nd or 3rd. This actually, it's any loans originated after August 1st have to be using the new form. So they'd have to use the new loan estimate, and then they'd have to go through underwriting and processing, and then so we more than likely won't see some of the closing disclosure forms hit the closing tables until end of August, 1st of September.
Okay, very good. And as a lender, I'll tell you, we're working way ahead of that. Every lender, most lenders that I know are already working on this to make sure we're fully ready to go by that time frame.
Yep, absolutely. Again, this is lending, title, all of the vendors working hand in hand together to make sure that we meet these timelines. I have been asked before, kind of like the old 2011 HUD changes, which many of you on the line will probably remember those, and that was just a change of a form. this is a change in procedure, so much different, and the government has basically given us, August 1 is your deadline, and if you don't meet that requirement, then you are subject to fines. So the new disclosure forms, like I said before, are made up of two new forms. It's the loan estimate and the closing disclosure. The good news is these actually are shorter forms. So in the past, you had to have a good faith estimate and an initial truth in lending statement. So the TIL was 2 pages, the GFE was 3, so a total of 5 pages. That's now replaced with a 2-page loan estimate form. And then the closing disclosure replaces the old HUD and then the final truth in lending. So that old HUD statement was 4 pages long. The truth in lending was usually about 2, so 6 pages, now going down to 5. Also, please note there is a separate seller disclosure that goes out that does not include any of the borrower information. So we have 2 sides of this form: a borrower's closing disclosure and then a seller's closing disclosure. So the timing of these. The loan estimate and the closing disclosure, and this is where a lot of the change occurs. So on the loan estimate side of things, delivery must be within 3 days of application, and then it must be delivered 7 days prior to closing, and then must be redisclosed within 3 days of learning of a change to loan term to the loan terms. On the closing disclosure, this is where it changes closing a little bit. So everyone, hear me out. By federal law, this closing disclosure statement must be in the consumer's hands, the borrower, 3 days prior to closing. So I'm looking here. It's consummation. I still call it closing. So, but 3 days prior by federal law, or parties are subject to fine and penalties. So very important to remember on that 3 days.
I know that most lenders are taking ownership of this time frame because obviously we need to make sure that it gets in everyone's hands prior to the closing date, and so that we can meet an on-time closing. How will this affect realtors in terms of their final walkthrough plans? Because I can see a lot of people do their final walkthrough a day before. How is that going to change the realtor environment?
It definitely is going to have an effect. In years past, we've all had closings that are they're rushed for whatever reason. Perhaps we're waiting on borrowers' information to come in, and there's a time schedule, and everything has to close on time, and walkthroughs immediately prior to closing, and rushing into the closing room to sign. This 3 days will actually give a couple of extra days there of leniency for the realtor to get that walkthrough done. They're still going to want to get it done as close to closing as possible to make sure that nothing has changed there prior. We do need to be aware that like Mike said, most lenders are taking responsibility of delivery of the form to their borrowers. So therefore, the lenders are preparing the forms in several cases. This is the lender's discretion. They can either allow the title provider to provide the forms, or they will provide the forms. So what happens if there is a repair credit that pops up? What happens if there's something else that happens? Well, it's going to have to go back through the lender channels for the credit to appear. What I just make sure to tell everyone is make sure that you're not the guinea pig in this case. Why don't we make sure that the review of the settlement statement, the review of the closing disclosure, you've seen it, you've talked with your borrowers, you've reviewed it well ahead of time, so there are no surprises that pop up at the end, because none of us want to be the guinea pig in this.
Yeah, absolutely. I can just see that with 3 days, somebody's not going to review that closing disclosure until the day before, and if there's changes, then it could trigger a new 3-day waiting period. So
it does, and if it's a change to the loan terms, it absolutely can. So we want to make sure that those borrowers and then their realtors, they're all reviewing this information well ahead. So I mean, if you think about it, though, if it's done properly, this should eliminate any of the errors and rush and last-minute issues that closing sometimes causes. So we do have to define what a business day is because we are talking about this 3 days and 7 days. So the loan estimate, a business day, is any day on which creditors' offices are open to the public. So many banks and lenders are now open on Saturdays. So Saturday is now probably you're going to see that as a business day, and then the closing disclosure, the business day is any day except Sunday and legal public holidays. So make sure too, I would just, legal public holidays, you're going to want to probably Google that and have that list down. We always download what the banks, the FDIC registers as legal public holidays. So that's MLK, that's Columbus Day, that's a lot of other days than just your traditional, Christmases and Thanksgivings. All right, so now this is a great slide because it shows you, we're still going to all be focusing on a Friday closing. That's typically when everyone's going to want to move in and move out of the home. So to close on Friday, those disclosures are going to be due the preceding Tuesday. So for the title industry, we're kind of smiling about this because, quite frankly, I'd rather have a bad Tuesday than a bad Friday. So we'll be busy Tuesday. We'll be working right up to 11:59 p.m. at night getting these disclosures out, and then waiting and answering any questions in the interim to be able to close on Friday. But by Friday, everyone has now seen the forms for 3 days, and they've answered any and all questions.
Great point. Great slide.
Yeah, that's definitely a good one. So we're gonna show the loan estimate. I'm going to go through this quickly because I want to focus more. This is our real estate partners on the line here, so I want to focus more on the closing disclosure. What will be shown at closing. So this is just a quick look at what the loan estimate looks like. This replaces the good faith estimate. So page 1 is just an overview of the loan estimate. We'll move on to page 2, and it's just again, the preliminary estimates of the loan cost and calculation of the cash to close. And then lastly, the page 3 is just the comparisons and the confirmation receipt. So that's the loan estimate. That's more for the lenders and the borrowers to concern themselves with. For our purposes here today with the real estate partners, we want to focus on these closing disclosures. So I will say this: I like these forms a lot. When you first see them, of course, it's just culture shock. We're used to seeing our good old HUD with lots of lines all over it, and we're just accustomed to seeing what we're accustomed to seeing. But if you think about a closing disclosure form, let's think about this from a borrower standpoint. A lot of these are first-time home buyers. They don't know what we know, and when they walk into that closing, there's a few things that always come to light very quickly. The first 5 questions of closing, almost every single one of them, is how much am I borrowing, what's my interest rate, what's my total payment, and is the loan escrowed, and what's my cash to close. And in the past, we had to dig, and cash to close, okay, that's on the HUD. And then, the payment letter is going to have the total monthly payment with the escrow breakdown. Then we're going to have to dig into the note to find out what the interest rate is. This form, with the first page, answers all the questions of closing, or at least 90% of the questions of closing. So here's page 1, right at the top, all of the familiar closing information, borrower's name, seller's names, etc. The loan terms, right there highlighted. Here's your loan amount, $162,000. Here's your interest rate. Here's your monthly principal and interest payment. And then just below that are the prepayment penalty or balloon payment, clearly marked yes or no. So I clearly can see can any of this change or hurt me afterwards. The next section here, the projected payments at the bottom, that has your escrows built in there, and it shows you there on the left years 1 to 7 and then years 8 to 30. So that's already taken into account if it's an adjustable rate mortgage, and it clearly shows you what the adjustment will be. So, you know, those of us that survived the meltdown and the subprime and everything that happened before, where you know the good old pick-a-pay loans or whatever it might be, and you close with a 1.99% and you walk out the door and it went to 18. Now you get to see exactly what that change can be, and then down at the very bottom, cash to close, very clearly spelled out. So I really love page 1 of the closing disclosure.
Very good.
So we'll move forward.
I want to bring everybody's attention to the link that you see in the middle. If you go into your browser and just type in closing-disclosure.com, I know these forms are a little small right now, but you can get a much closer view and a much more detailed view of these documents if you just type into your browser closing-disclosure.com. It'll take you right to Aaron's company website where it has these forms in more detail.
Yes, thank you for that. It sends you straight there, and you can look at these forms, you know, right there, and have access to them at any time. So, page 2 of the closing disclosure. This one looks fairly similar. You know, the top part here is going to have your loan cost breakdown. So all charges, origination, or services that were used for the closing, those are all there. But what I'd like to bring to everyone's attention. Remember in the past the old POC, paid outside of closing, where it would the POC items would show up in the margins of the HUD. Those are no longer. Everything here has its own column. So you'll notice borrower paid, and you've got a column for at closing or before closing. Then you've got seller paid at closing or before closing, and then a column at the very end, paid by others. So if the lender is paying for the appraisal, or if you know, the home inspection was included for free, it's going to show up in that paid by others column, so that everything has a place. Every charge of closing, it all appears somewhere. Down at the bottom of this page in other cost, you can see that we have the recording charges, your state, local doc stamps and tangible taxes and whatnot. You've got your prepaid items, so your homeowner's insurance and mortgage insurance. And then you've got the setup of your escrow account. And I feel that's important as well, because it separates the escrow account from the loan closing costs, because truly they're not a cost of closing. If you pay this loan off tomorrow, that escrow account belongs to you. So real estate professionals, look in the next section is section H, other. So where you used to find your real estate commissions was in 701, 702. We're now in H, other. You're in H05 and H06. So that's the biggest change from a real estate professional's perspective so far, is just to make sure you know where to look to verify your commissions. So we'll
Quick question for you, Aaron. I had a question come across. Does the seller receive the initial page with the borrower's financing terms?
The seller will not. That's the great question. The seller will have their own form. It's a 2-page seller's disclosure with only the seller's information on there. So remember, we're in this day and age of protection of financial data. You know, that always does have a bit of an uneasy feeling at closing, is you know, the borrower's interest rate and payments and a lot of their financials kind of being discussed in front of the seller. So now the seller gets their own page with no borrower's information on it.
Okay, thank you.
Yep. So page 3 of the closing disclosure, at the top of this form is just a quick calculation on how we calculated the cash to close, and it's really just tallying those previous columns together to get us to the cash to close. And the bottom of the form, summaries of the transaction. This looks very familiar. This should make everyone feel all warm and fuzzy, because now it looks just like the page 1 of the old HUD, where you've got your sales price and your tax prorations and prorations of homeowners association dues all there, and gets you to those bottom lines, the old cash to close from the borrower, and then now here's where the cash to close, or cash to the seller appears here. And please note, this is the first time you've seen anything to do with the seller. Remember, these are all borrower-friendly forms. So again, the seller's information will be on a separate form. So page 4 Page 4 I like. You know, this is a little bit new, but what page 4 does is brings forward a lot of the information that was formerly found in the note. In the note is this loan assumable? Is there a due on sale clause? Is this a loan negative amortization? Is there an escrow account attached to this loan? And then in what is the security interest in the property? So a lot of the terms from the note are brought here to the closing disclosure page 4. Remember, the lender will be getting the closing disclosure to the borrowers 3 days prior. So in having this information, even if the note isn't delivered, it is in this form. So I do like the fact that it's all here. And now we're going to look at the final page of the closing disclosure. Up in the top left, this looks familiar. This is some of the old truth in lending with the calculation of the APR, the annual percentage rate. So you've got that information there in the top left. In the top right, you have other disclosures in regards to the appraisal or the contract or any liability that can happen after foreclosure. So just some good disclosure information for those borrowers. And right there in the middle of the page, if you didn't believe me before that HUD is no longer in charge and RESPA is no longer in charge, that is the link to the CFPB website, consumerfinance.gov. And if you notice what that says is questions. If you have questions about the loan terms and costs on this form, contact your lender. But to get more information or make a complaint, please contact the CFPB. And you rest assured, the minute you go to CFPB website, what's over there in the big and bright on the right-hand side is file a complaint here. So this is the CFPB is here to protect consumers at literally any cost. Down here at the bottom of the form, I do like this. This is really neat for real estate agents and parties to the transaction. It actually has your name, company name, your email address, and cell phone all there on the closing disclosure statement. So you kind of have a little bit of forever marketing going on here. So, you know, borrowers and your buyers and sellers will lose a business card or lose a phone number, but they typically will keep this form. You know, there's a few documents of closing that always get kept. The old HUD, the survey, owner's policy, and maybe some of the loan package, but they always seem to keep this form. So at least you've got your cell phone and email address there for here to eternity. And at the very bottom was just the confirmation. So what are the impacts to our real estate agent? Well, overall, I mean, of course, change is always change. It's always difficult, but the one thing that's constant in our world is change. So overall, this is a positive impact. You know, having the clarity on these forms, having the forms in the borrower's hands 3 full days prior to closing. These should all have a positive effect on the industry and the transaction, you know, going forward. So I think what's going to happen is that getting it done 3 days prior will slow down the transaction as far as the stress goes, and it'll kind of calm the transaction down. But this will actually speed up the transaction. So these 3 days. Because of how this all is playing out with lenders being able to actively select which of the title vendors or attorney's office that they want to partner with in certain markets, them having that kind of connection is really going to help speed this process up. You know, there was a webinar I was listening to recently, and one of the national brand underwriters that we use, the CEO was quoted as saying, I can walk into a car dealership and buy a $100,000 car in about an hour, but to buy a $100,000 house on national average takes about 60 days. We need to fix that. And so with this change, with this form, and kind of with the lender having a much more control over the transaction, the view is that it will speed things up It'll cut a lot of time, a lot of finger pointing out of the process, and ultimately this will result in a very collaborative effort by all parties to push forward to closing.
Great points, Aaron. Thank you very much. That's a lot of great information. I did have a question from the audience regarding the point on meter readings. We don't see that very often as part of settlement statements. Are you seeing that a bunch?
Not in settlement statements so much. That's more so, in some of the areas across the country, there may be a final electric meter reading or water meter reading. Remember, these are not, this is national forms, and so in certain areas you may have proration of those items up to the date of closing. But I know in Florida, I know in Florida, for instance, it's not truly the norm.
Exactly. Okay, and I have a question from the audience regarding if you will receive copies of the slide presentation. Yes, we are going to make this entire presentation available to you. Once this webinar concludes, you'll get a short survey that we will appreciate you responding in terms of your response, your feedback regarding the webinar, as well as then we'll send you a link to all of the AEM Achieve events, including this event. So please complete that survey for us. We would really appreciate it. And we'd love to hear your thoughts on any future events. So Aaron, can't thank you enough for the great presentation, really outstanding information, and you are the expert. I recognize you as the expert. That's why you've been doing it so long. Our next AEM Achieve event in February, we're still finalizing the details. We had a shift in our resource that was going to present for February, so more details will be coming. Keep an eye out for your email. We definitely appreciate all of you attending today. Please feel free to email us at any time if we can help you in any way. This concludes our event for today. Unless we have any other questions, I'm not seeing any questions for our audience, but we'll be happy to entertain a few. We've got a couple extra minutes. Okay, I think I've got a question here.
Mike,
I think I've got it.
Go ahead.
The image that comes to mind when I hear Dodd-Frank is Barney Frank defending subprime loans, even as the evidence was in that they were causing a meltdown of the economy. Any comment regarding Barney Frank's comment on that, Aaron?
Oh,
that's a pretty broad topic. I think we better leave that one alone.
That has political implications to it, and I'm staying far away from that one.
Okay, very good. I understand. Well, again, thank you very much for attending, everyone. We appreciate it. Have a great day.